Think sneakers. Ever noticed how sneaker prices can be different in different stores? That's arbitrage. Before we dive in, make sure to hit that subscribe button and click the bell icon. Imagine buying a pair for $100 at one store and instantly selling them for $120 at another. That's a $20 profit, minus any travel costs. Crypto arbitrage is the same idea, but with digital currencies like Bitcoin or Ethereum. You're buying low on one exchange and selling high on another, all thanks to price differences. It's like being a digital sneaker reseller, but way faster. Instead of driving around, you're making clicks, and instead of waiting for buyers, the trades happen instantly. The key is speed and knowing where to look for those price gaps, but don't worry, we'll cover all that. Crypto arbitrage comes in three main flavors, each with its own unique approach and opportunities for profit. Understanding these types is key to navigating the fast-paced world of crypto trading, and can help you spot chances to make money that others might miss. First, spatial arbitrage. This is the sneaker example we talked about earlier, but applied to crypto. Imagine you notice Bitcoin is selling for a lower price on one exchange and a higher price on another. You buy Bitcoin on exchange A where it's cheap, transfer it to exchange B where it's more expensive, and sell it there for a profit. For instance, if Bitcoin is $29,500 on Binance but $30,000 on Coinbase, you buy on Binance, move your Bitcoin to Coinbase, and sell it for a quick gain. This method is straightforward, but you have to be quick. Prices can change in seconds, and transfer fees or withdrawal limits can eat into your profits if you're not careful. Next, we have triangular arbitrage. This one's a bit more complex, but also more interesting. It involves three different cryptocurrencies, all traded on the same exchange. Here, you're looking for price differences between trading pairs. For example, you might start with Bitcoin, trade it for Ethereum, then swap Ethereum for Litecoin, and finally convert Litecoin back to Bitcoin. If the prices line up just right, you'll end up with more Bitcoin than you started with, all without ever leaving the exchange. This strategy requires sharp attention to detail and quick execution, since the opportunity can disappear in a flash. Then there's DeFi arbitrage. This is like playing with robots in the world of decentralized finance, or DeFi. Instead of using traditional exchanges, you interact with smart contracts on decentralized platforms. Here you can lend and borrow cryptocurrencies, taking advantage of differences in interest rates between platforms. For example, if Aave offers a 5% lending rate for Ethereum, while Compound offers 6%, you could borrow Ethereum from Aave, lend it on Compound, and pocket the 1% difference. DeFi arbitrage can get even more creative, involving flash loans or automated bots to execute trades in seconds. But it also comes with its own risks, like smart contract bugs or sudden changes in rates. Each flavor of arbitrage has its own quirks, challenges, and profit potential. Some require speed, others demand careful calculation, and all of them need a solid understanding of how crypto markets work. In the next chapters, we'll dive deeper into each one, exploring real-world examples and tips to help you get started. You might be thinking, isn't everyone doing this already? Surprisingly, no. Here's why arbitrage opportunities still exist in 2025. First, market inefficiencies. The crypto market is like a teenager, full of energy and prone to mood swings. Prices fluctuate wildly, creating those juicy price gaps. Second, different exchanges. Imagine hundreds of sneaker stores, each with its own prices. That's crypto exchanges for you. Each has its own fees, trading volumes, and user base, leading to price discrepancies. Third, slow transactions. Even in 2025, moving money between exchanges can take time. This delay creates opportunities for those who are quick and prepared. So, while competition exists, there's still plenty of room for savvy beginners to profit from arbitrage. Ready to make your first arbitrage trade? Let's break it down. Step 1. Choose your exchanges. Sign up on at least 2 reputable exchanges with a history of fast transactions and decent liquidity. Step 2. Spot the gap. Use price tracking websites or apps. We'll cover some soon, to find cryptocurrencies with significant price differences between your chosen exchanges. Step 3. Prepare your funds. Have some crypto ready to go on your starting exchange. Remember, speed is key. Step 4. Act fast. Once you've found a good opportunity, buy the cryptocurrency on the cheaper exchange and immediately place a sell order on the pricier one. Step 5. Calculate profit. After the trade, deduct trading fees and transfer costs to determine your actual profit. Remember, practice makes perfect. Start with small amounts and gradually increase your investment as you gain experience. So, you really don't have to be glued to your screen 24/7 just to find arbitrage opportunities. There are some awesome tools and bots out there that can totally help. For example, Arbitrage Pro is this powerful software that constantly scans multiple exchanges for arbitrage opportunities, and it notifies you instantly whenever a profitable trade pops up. Then, there's CryptoArb Bot, which is an automated bot that basically does the heavy lifting for you. It executes trades automatically, based on the parameters you've set. And while CoinMarketCap Pro isn't strictly an arbitrage tool, its price alerts and portfolio tracker can actually be super valuable for spotting price discrepancies and managing your trades. Honestly, these are just a few examples, and there are always more tools being developed, so go ahead and explore. Find what works best for you. Alright, let's talk about the three main paths to arbitrage profits. Each method has its own unique flavor, and the right choice really depends on your personality, goals, and resources. First up, there's manual trading. This means you find the opportunities and execute the trades yourself, keeping your finger on the pulse of the market at all times. It's definitely the most hands-on approach, but it gives you more control and flexibility. You get to make every decision, react to news instantly, and adapt your strategy on the fly. The pros? Well, you get full control, there's potential for higher profits, and it's a great way to learn. You'll develop a deep understanding of the markets, and every win feels truly earned. The cons, though, are that it's time-consuming, requires constant monitoring, and there's always the chance for human error. Burnout is real, and missing a key opportunity can be frustrating. Next, we've got using arbitrage bots. These are automated programs designed to scan the markets and execute trades for you, often much faster than any human could. These automated programs do the trading for you, which can really free up your time. You can focus on other things or even sleep while your bot works tirelessly in the background. But they do require some technical know-how to set up, and honestly, they can be a bit pricey. You'll need to research, configure, and sometimes even troubleshoot your bot. The pros here are that bots save you time, work around the clock, and eliminate emotional trading. They can catch opportunities you might miss and execute trades in milliseconds. The cons? Well, you'll need to handle the technical setup, there's potential for bot errors, and as I mentioned, it can get costly. Plus, if the market changes suddenly, bots might not always adapt as quickly as a human would. Quick reminder, subscribe to Crypto Kryptonite while you remember. Thank you. Finally, there's DeFi arbitrage. This involves using smart contracts and DeFi protocols to take advantage of interest rate differences. It's a newer, tech-driven approach that's shaking up the world of finance. It's a bit complex, but it can be very lucrative. If you're comfortable with blockchain technology, DeFi arbitrage opens up a world of creative strategies and passive earning. The pros are high profit potential, a passive income stream, and it's accessible 24/7. You can earn while you sleep, and the decentralized nature means fewer barriers to entry. But the cons are that it requires advanced knowledge of DeFi, there are smart contract risks, and you might face impermanent loss. The learning curve is steep, and security is always a concern. So, in the end, the best approach really depends on your risk tolerance, how much time you want to commit, and your technical expertise. Take your time to explore each path and choose the one that fits your lifestyle and ambitions best. Alright, let's talk about some beginner traps and how you can avoid them. If you're just starting out with crypto arbitrage, it's easy to get excited by the potential profits and overlook some of the common mistakes that trip up new traders. But being aware of these pitfalls from the start can save you a lot of money, time, and stress down the road. Crypto arbitrage isn't without its risks, so it's important to know what to watch out for. Even experienced traders can fall victim to these traps if they're not careful, so staying vigilant is key. Here are some common pitfalls to avoid. Make sure you keep these in mind every time you plan a trade. First, slow withdrawals. Some exchanges have slow withdrawal times, which can eat into your profits or even cause you to miss opportunities altogether. If your funds are stuck in limbo, you might not be able to act quickly enough when prices change. Second, high fees. Always factor in trading and withdrawal fees when calculating potential profits. Fees can be hidden or higher than you expect, especially when moving funds between different platforms. High fees can quickly turn a profitable trade into a losing one. Even small percentage fees add up over multiple trades, so always double-check the costs before you commit. Third, verification issues. Some exchanges have lengthy verification processes, which can delay your trades and cost you opportunities. If you haven't completed verification in advance, you might be stuck waiting when you need to move fast. Fourth, scams. Be wary of fake exchanges or those too good to be true arbitrage opportunities. Scammers often target beginners with promises of easy money, so always do your research and never trust a platform just because it looks professional. It's best to stick to reputable platforms with a proven track record. Look for reviews, community feedback, and security features before depositing any funds. And fifth, price volatility. Crypto prices can swing wildly, so what seems like a profitable opportunity can quickly turn sour. Sudden market moves can wipe out your gains or even leave you with losses if you're not prepared. Always use stop-loss orders to minimize potential losses. Setting clear exit points helps protect your capital and keeps your emotions in check during fast-moving markets. By being aware of these risks and taking the right precautions, you can significantly reduce your chances of running into trouble. Remember, successful arbitrage is about smart planning and risk management, not just chasing quick profits. Now, here are 5 actionable tips to help you maximize your arbitrage success. First, embrace stablecoins. Use stablecoins like USDT or USDC for faster transfers between exchanges and to minimize your exposure to price volatility during trades. Second, choose speedy exchanges. Opt for exchanges known for their fast transaction speeds and efficient withdrawal processes. Third, split your funds. Don't put all your eggs in one basket. It's a good idea to diversify your funds across multiple exchanges to take advantage of more opportunities. Fourth, test the waters. Start with small amounts to get a feel for the process and identify any potential issues before committing significant capital. And fifth, low fees are key. Choose exchanges and trading platforms with low fees to maximize your profits. Every penny counts. By implementing these tips, you'll be well on your way to becoming a smarter and more profitable arbitrage trader. So, how much can you really make with crypto arbitrage? While profits can vary quite a bit, realistic returns for beginners typically range from 0.5% to 2% per trade. Experienced arbitrageurs with advanced tools and strategies might achieve higher returns. For example, let's say you start with $1,000 and make 5 successful trades per day, averaging a 1% profit per trade. After a month, you could potentially earn around $150 in profit. But remember, these are just estimates. Your actual earnings will depend on a bunch of factors like your capital, risk tolerance, and the current market conditions. Alright, if you're ready to dive in, here's a simple action plan to get you started. First, choose your exchanges. Start with reputable exchanges like Binance, Coinbase Pro, and Kraken, since they're known for their liquidity and security. Second, pick your tools. Try out free or trial versions of arbitrage tools like Arbitrage Pro or CoinMarketCap Pro to help you find profitable opportunities. Third, start small and learn. Begin with a small amount of capital, practice finding price differences, and execute a few test trades to really understand the process. Fourth, gradually scale up. As you gain experience and confidence, slowly increase your investment amount and explore more advanced strategies. And fifth, never stop learning. The crypto market is always evolving. Stay updated on the latest trends, tools, and techniques to stay ahead of the game. Remember, patience, persistence, and continuous learning are key to long-term success in crypto arbitrage. So, start small, manage your risks, and enjoy the exciting world of digital asset trading. And don't forget to subscribe to Crypto Kryptonite for more amazing crypto news and stay updated on the world of crypto.